Here at River1 Asset Management, we have a saying, if a public company puts their name on a stadium, look out below. This stock is Fiserv, the ticker is FISV, and this is about when they did it, and look out below. It's been a real troubled name lately. We're gonna go through what's going on at Fiserv and whether or not there's value in this company down here. So let's take a look at what Fiserv was before we take a look at what it is today. And Fiserv was a really good slow growth company. Take a look at 2015 through 2018 here. $5 billion in revenue, about $2 billion in EBITDA, and $1 billion in net income. And they had about $4 billion net on the balance sheet. Kind of levered, not crazy levered, right? What happened in 2019? Why did they put $24 billion in debt on the balance sheet? They bought a company called FDC, First Data Corp. First Data Corp came out of KKR, private equity, was labeled with a ton of debt. They couldn't make any money as a public company. The stock wouldn't go anywhere as a public company. And so Fiserv bought it for what it thought was on the cheap and assumed all of this debt. Now Fiserv became a growing company, but became a company with a lot of debt. Let's take a look at what happened when they went from $6 billion in revenue to $10 billion in revenue and beyond. So take a look at the growth that happened post-deal, and it was pretty solid. 5% top line growth was pretty typical for them. In 2022, they did 10. In 2024, at the peak, they did 20. What were they actually rolling out? Well, First Data had this really good thing that was coming out that was new and incredible. It was Clover. Clover is just like Square or all of these other payment systems, and it was growing like crazy post-COVID, and they were doing a really good job. What happened was the growth peaked, however. Peaked before they could pay off all this debt for taking on the company, and when the growth peaked, the valuation peaked. As you can see, the growth of Clover, very, very anemic here, which is why when we take a look today, we'll see a totally different multiple on this stock. So after this recent sell-off, let's take a look at where it's at. It does have a decent debt pile that we need to worry about here. $29 billion in debt against about $8 billion in EBITDA. That's about 3.5x leverage, right on the border of where we get a little bit worried here. But let's take a look at valuation, and it's pretty attractive. $9 to $10 billion in EBITDA against $55 billion in enterprise value. That is about 6 times EV to EBITDA, cheap. Let's go all the way down to the EPS line as well. $10 in EPS expected out here in 2028 against a $50 stock price. That is a 5 PE out 2 years. And the free cash flow metrics are the exact same. Almost $5 billion in free cash flow against $55 billion. That's about a 9% free cash flow yield. This is cheap on all levels, if you believe the numbers. But most stocks are cheap for a reason. And here's the reason. The market hates negative revenue growth, and take a look at the expectations for 2026, negative 5%. Now the models have it going back to its typical growth from back in the day going forward, which would push EPS up almost 10%, which is what made the stock rally in the first place. But the market clearly doesn't believe that this is 100% chance that this is going to happen. It is worried that the revenue growth, the negative revenue growth, is going to continue on trend, and this stock will just continue to leak oil. When the CEO, who just started, can convince the market that the oil leak is fixed, we think that there's a lot of value in Fiserv down here, but you're gonna have to wait for that moment where the market takes a look at this and says, okay, the worst is over, we can re-rate this a little higher.